Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. Today's super important update. We've got a lot to talk about. I'm going to speak very slowly, very methodically, and we're going to have an agenda that I'll follow without rambling. That's my promise to you. If you're not already aware, I'm a popular investor on eToro, and today we're going to talk about me being upgraded to the level of champion, having champion status in eToro. Thank you very much for everyone that has supported me and all the investors and copiers. We're at a turbulent time during the market. I believe we're at a key inflection point that we will look back on in perhaps a decade in terms of seeing where money flows have rotated out of one sector and into another. Going to get straight into it, guys. If you haven't already liked and subscribed to the channel, I'd greatly appreciate you doing so. And if you want to follow me for further analysis on eToro, obviously just add me to a watch list on eToro. So without further ado, thank you for all the support, and we're going to get right into it because we have a lot to talk about. So agenda for this presentation, I'm going to keep it shorter, guys. I don't want to be taking up too much of your time. I want to be key and concise. So first of all, thank you very much to everyone that has had the confidence in me and my abilities to invest some of your hard-earned money. I and my family are the largest investors in the portfolio. We're continuing to add in from all our different investment income as they come in into the fund. Okay, so I think that's really key. The key test is, do you eat your own cooking, as Nassim Taleb would say? In other words, do I have skin in the game? Do I have my own hard-earned cash and investment cash in this portfolio? And the answer is yes. And I am the largest investor. I'm going to reflect on some wins and some losses over the last almost 9 months that I've been doing the Popular Investment Program, and mistakes that I've made and corrections moving forwards. This is going to be key because I'm going to contrast the Crassus investment portfolio, that on eToro, versus the performance that I've had with the Crassus arbitrage, which is my derivatives trading portfolio. And I'm going to talk about why that's really important, because I've been getting amazing returns in my own derivatives fund, and yet the portfolio has been going sideways for a quarter, and we're down about 10% year on year, which is still better than the average market. But I know that I can do better, and I can prove it given by what I've done in the arbitrage fund. We're going to talk about the broad index, so the market, the SPX. I'll look at some charts, momentum, where I think it's heading, and where the downside targets are in the medium term, and where I'm going to roll the short positions that I have. I'm going to give you a pie chart visual of the portfolio allocation as I am going to construct it. Okay, there's a lot to talk about there, so I'm going to get straight into that. And I'm going to give, again, the rationale for the capital allocation. I'm going to tell you where I'm going to change the portfolio, how I'm going to construct it, and the reasons why. You'll be familiar with quite a lot of those reasons because the themes are the same. The money flows and the rotation of capital, where I think money is coming out of and where I think it's going to go into over the next decade, overvalued and undervalued sectors. Okay. Thank you again. It's going to be looked at as a retirement fund, this eToro portfolio. I mean, I guess I'm a professional investor and retired if I wanted to be, but this is really important to me to be able to form a vehicle that will be able to protect and grow people's capital for the long term. And one key thing is that I've shied away from a lot of dividend distributions because of, I just get killed for dividend distributions in personal funds because I'm in a high tax bracket. And so I didn't want that to be the case for the people that would invest in the portfolio. There are people from all around the world invested in the portfolio, and so I don't know what your given tax jurisdictions are, but I'm going to ignore that now, and I'm going to focus on free cash flows even more so, and dividend reinvestments. Okay, sticking to contrarian, lack of conviction prior was a mistake. I have followed the crowd a little bit in terms of some of the other people on eToro, the popular investors. I think the biggest difference for me, and why it's so annoying for me to be flat on the public portfolio and be up 20% CAGRs in my personal portfolio, is simply because some of those themes are controversial. Some of those themes people don't understand very well, and they're out of favor. But of course, those out of favor sectors are exactly where the bargains are. So I'm going to be shutting out any noise from the outside, even with people that are invested in the portfolio asking me different questions, and obviously I want to answer that. But it's amazing how sometimes underneath your conscious mind, whether or not that's playing a part in it. And so I'm going to talk about that. We're going to continue to do what we always do and buy undervalued assets at their discounts. So here's a visual so you guys really understand. So over the back here, you'll see the performance of Q1 of my options trading fund. So you can see here for the first quarter, Crassus arbitrage is up 5%, which obviously is around 20% annualized, which is fantastic returns. Very happy. And so to be outperforming the broad index by 9.1%, you can see the difference between these two lines here. That's the alpha. That's exactly what I want to achieve. And it's the same investor over there that's running the e-toro portfolio, whereas the e-toro portfolio is going sideways in Q1. So it's what am I going to do? What's happening that's different, and what am I going to do moving forwards? What's happening that is different is that I've been way too conservative with the eToro fund because I've allowed these other images to enter my mind, such that I've tried to quieten volatility so that some of the investors don't get spooked, trying to obviously retain copiers and investors, whereas I really should just stick to what I know. And if someone then doesn't want to copy me, then so be it. Because over the long term, the goal is to create a machine that compounds on an annualized basis, an annualized average of 20% year on year. And I know how to do that. And I need to just simply ignore other people and apply what I have proven to be able to do across into a different domain. Simple as that. So that's, I guess, one mistake that I've made and a correction that I'll be doing moving forwards. I am not following any other popular investors. I'm not following many other investors other than a few macro commentators. I'm simply doing, not allowing any outside influence. And sometimes you think you're doing that consciously, but unconsciously, perhaps, I don't know, if someone's messaging me saying, oh, we're up, and they're really happy on the fund's performance, and then they're messaging you saying, oh, what's happening is down. To me, I mean, guys, I'm a commodity investor. I see my account fluctuating by large amounts, and I don't lose any sleep over it. I know what I own. I know how I'm positioned, and I think that I just have to not let those outside influences affect the decision making. I would care a lot less about the mark to market and month on month performance. It's a great thing about eToro is that you can see month on month how someone's portfolio is doing. And it's also a trick because it only gives you a short snapshot in time. And the true test of investment is obviously time and that compounding. So sometimes as a manager, this is what I've noticed going from being a private investor, going into investing in public markets. It's that month to month, every second of every trading day, your portfolio is being marked to the market every instant. Whereas if you're investing in real estate or if you're doing private buyouts that I've done in the past, those things, obviously, you're not getting market quotes every 2 seconds for your physiotherapy clinic, or you're not getting market quotes for your residential property portfolio. I mean, can you imagine? And so I think that's the difference, is ignoring month on month, mark to market, whether someone else is doing better or the fund is up or the fund is down or whatever, and just focusing on the big picture of what I want to achieve. Here we are. So this is the portfolio structure moving forward, at least for the short to medium term. So when I've broken down here, the first thing that you'll notice is that it adds up to more than 100%. Okay. And I want to be clear about this. This is because for some of these short positions, I will be looking to use the leverage. Okay. And I've spoken about partially about where I think the market's going, and we'll touch on that in a second. So the main part is still, I'm going to be long general equities, high quality businesses, high free cash flow yields, a little bit more focused on dividend distribution. And this is another thing, talking about mark to market. My performance is a lot better than what it says on eToro, because eToro performance doesn't take into account dividends. And so then I started to think, well, maybe I need to focus more on growth, which is silly. Long general equities up to 50%. I'm going to overweight the fund with energy. It is my biggest position in the arbitrage fund. And so it makes no sense as to why it would not be the biggest position moving forwards, given the fact that we're in the midst of an energy crisis that I have not only seen coming for 2 years, but I've been telling you guys about it. And still, I think I've been underweight energy, okay? This is what I mean by not backing my own convictions has probably been the number one mistake. And I intend to correct that moving forwards. Okay. Utilities at 3%, financials 2%, and you guys can see the breakdown here. I'm not going to belabor the point, but half of the portfolio will remain long in general equities, being overweight energy. We will then be taking short position up to 30% of assets under management in the fund or in the portfolio. I will be short, we are already short the SPY, which is an ETF that tracks the broad index, okay? There's a little bit of leverage used on that. I can use more if I need. We will also be short the QQQ, which tracks the NASDAQ. I shorted the NASDAQ. We made a profit. I rolled out of that as the actual index. That's marked to market all the time. And so I'm going to move that into the ETF. I think the ETF will perform ever so slightly worse than the index, which is why I'm choosing to short the ETF. And that's for reasons such as fees on redemption. That's all. Okay. Yes, the QQQ tracks the NASDAQ. So it is the same thing. But I think ETFs will allow me not to focus on day-to-day fluctuations or minute-to-minute fluctuations, but more on the bigger picture. And I think that there's obviously the redemption fees to take into account, which I think will hurt the performance of those funds. IEF is the bonds, okay? So 2 to 7 year treasuries. So we are looking to build out a short position again in bonds. I think money is going to fall out of the broad index and out of bonds as we're coming into a process of quantitative tightening starting in June, with interest rates being allowed to rise. So there are short positions up to 30% of the fund. Cash at 20%, large allocation. I'm not going to use too much of that at the moment. I'm going to hopefully roll the short through at a profit if what I think happens in the broad index, the SPX, is going to drop down. We are going to own high quality individual companies. And so what you should find with this long short trade is that generally, I think stocks will revert back to their median CAPE ratios or the median PE ratios of about 15%, which means they've probably got another 30 to 40% to go. Over the broad index, we think that at least the higher quality companies will fall less in value or perhaps even rise. And so there you have this difference between the broad index, which has just got a whole heap of overvalued companies right now. We're picking out the select companies that we want to go long in the general equities, and we're shorting the overall index, which we think is overvalued. Okay. Cash there acting as a great buffer. We'll use that as opportunities arise. Commodities up to 30%. Okay. So there's plus or minus 5 to 10% in the commodities, cash, and short positions. Okay. Depending on where the value is. Commodities, I think, are set for the next stage of their bull market. We will be looking at I will be looking at allocating up to 10% of the fund in uranium, okay? And uranium physical, uranium explorers, uranium producers, okay? And this is where the URF ETF comes into place, because we get exposure to all of those in one trade, which is the ETF. So that ETF is made up of the physical commodity itself via the Sprott Physical Uranium Trust and Yellowcake, which is another physical uranium trust that holds the yellow cake above the ground. Uranium is trading at a discount. Uranium is trading below its incentive cost of production. I think that uranium needs to be around about $75 before we start to have the miners come online again, and all these mines that have been shut down, in order to get them to start to reduce. As I say, I think the incentive price is at least $75. Uranium spot price is around $53. I think it closed over the weekend. And if you look at the physical uranium trusts, they're trading at about a 12 to even, in the case of Yellowcake, almost 20% discount to the net asset value. What does that mean? It means the uranium that they own in the warehouse, it is being valued by the price quote in the market for those companies, which, remember, all they do is hold uranium. It's valuing uranium at about $45 a pound, whereas the spot future is $53 or thereabouts since closing on Friday. Okay, so there's a huge arbitrage there already. I expect uranium to break triple digits before this is all said and done, because nuclear energy is simply going to be the form of power that makes most sense. We're in an energy crisis. We need energy, and people are wanting a source of energy that has low, or in this case, zero carbon emissions. There's nothing else that can get it done. It is uranium. There is no other option. Wheat at 2%, corn at 2%. I will be buying the Teucrium futures vehicles where they sell the back month and buy the forward month. And that way, with the markets in backwardation, where the future contracts further out are lower priced than the current spot price, they should continue to do very, very well. I'll make a separate video particularly for those. The commodity index here, okay, so this gives you access to broad, more sort of agricultural commodities, such as lean hogs in particular. I'll make a video about that. Aqua is a way that you can play water treatment. I'll be talking about that. I'm just letting you know what I'm doing, and I'm going to build out these positions very slowly over the rest of the year. St. Joe is a residential property development trust. I'll talk about that in a separate video, so I don't take up too much time now. Texas Land Corporation, that's a really interesting thing. Another video just for it. But you're getting royalties on certain water rights and things like that. And a lot of ways to play water as a pure commodity. Sugar futures and platinum ETF. I'm very interested in silver, and I need to find a spot for silver in there somewhere. Platinum continues to be undervalued relative to silver, so we go with platinum first. Maybe I'll break that up into a 1-on-1, 1% to platinum, 1% to the Sprott Physical Silver Trust. That remains to be seen. But this should give you a broad overview as to where the portfolio will be positioned moving forwards. And I will not be second guessing myself like I have done in the past. Okay, so why that? What's the rationale? Let's look at valuation. Always, for me personally, it comes down to valuation. And whenever you get away from that, it's where your performance starts to suffer, for me anyway, in the way that I invest. So what I've done here is take in from FinViz all the different industries or sectors, I should say, and sorted them by their forward PE. So how much the market's pricing in today versus next year's estimates of their earnings, okay? So how cheap are they today versus their earnings in the next 12 months? And I've listed them there from cheapest to most expensive, okay, or best value to least value, using that metric alone. So utilities, energy, basic materials, and consumer cyclicals are coming in the first 4 positions there, okay? Financial and healthcare, I think, will be very important. Financials will benefit from rising interest rates up to the point that they can increase their net interest margin. However, we do need to be careful in the types of loans that the financial institutions have written, because if interest rates rise such that they start to experience defaults, the bank's going to be the one lifting the bag. So we need to be really careful with that. So far, I've chosen to play financials, as you know, through fintech and payment processes. Healthcare is also going to form part of the portfolio. We've sold out of almost all our healthcare because we made profits. But healthcare's demand is inelastic, meaning it doesn't matter what happens in the overall environment, we still need to be taken care of, or else we die, right? So healthcare is an extremely inelastic demand. And so we'll look at that. Okay, I'm going to bring this chart up again. I've made a little adjustment to it. What's happening in the market? Hopefully you survived the last 2 weeks. They've been a little bit volatile, well, not a little bit volatile. They've been very volatile for most people, very stressful. We're going to look at where I think this index is going. And guys, I think it's going to go even further. I think we're going to get more selling pressure. I expect the multiple contraction to bring that CAPE down to 14 to 15. Okay, so what that is they take the S&P 500 and they look at their cyclically adjusted PE. Okay, just forget about that for a moment. Just think about the PE ratio, the price to earnings of the average of the big 500 companies in the US, the S&P. That's what this is measuring. And so when it's really high, it means you're paying a lot of money for the earnings, okay? And when it's low, it means you're getting a lot of earnings for not as much money, obviously. And I think historically, we've been around this 14 to 16 times. That's been the multiple the market's mostly been willing to pay. And I think we're going to revert back down to that. So another 20 to maybe even 30% correction in the SPY. If you look at the cash flow yield on the S&P, it's around 1.9%. Okay, so if you buy $100 worth of the S&P, every year you're getting a free cash yield of $1.09. 90 cents. Okay, so obviously that's not very good from a cash flow perspective, very expensive, versus our portfolio as it currently stands. And I'm going to get this a lot. I'm going to get this to 20% if I can, because that's where everywhere else that I'm invested in. So Crassus, we're at 12%. Okay, so we're getting a decent return on cash flow yield, but I think it can be better. And it's going to be extremely important based on rising interest rates and an inflationary environment. Why? Because as interest rates rise, all of a sudden people get paid more just to simply stay in cash. And so if you want to go further out that risk curve and invest in businesses such as publicly traded stocks, you can't just have this 1.9% earnings anymore, because inflation might be at 8%, you're losing money. At least if you're holding cash and you're getting, for instance, maybe 3 or 4%, you're still losing, but you're losing less than if you're buying the broad index. Okay, and so it has to come down in this, under this scenario, rationally. So where are we? Here you can see the charts for the S&P. This is the SPY Trust. It tracks the S&P. I expect us to get down to this blue line, which is the 200-day moving average. Okay, so this is on a weekly time frame. You can see the moving average divergence indicators hit a sell around about the start of 2022. Okay, as we started seeing the drop, and that turned out to be fairly accurate. RSI down the bottom here measures momentum, and we're heading all the way down. We're not at oversold yet, so we still got a little bit to go. And so I think once we start to hit 360 on the SPY, I'll begin to scale out of the shorts and roll that into to buying positions in equities, depending on what the situation of the market's like. But that's how I envision things going at the moment. Let's take a look at the Fed funds rate. Now, I was listening to a great interview today by Tavi Costa in the gym. And previously, as I spoke about in the last video, it seems crazy to think about the 10-year at 4.5% by bringing the Fed funds rate up. And Tavi seems to be of the opinion that they will start to go into yield curve control, which means that they'll allow the short end of the curve to rise, and then they'll start buying up the longer end of the yield, so 10 years and 30 years. And Tavi thinks that it's not unlikely at all. It's funny you mentioned the 4.5%. I mentioned the 4.5% last video, and I hear Tavi today also mentioning 4.5%. So he's also short the 10-year, which would be very very interesting. So as the 10-year drops in value, rises in yield, we expect equities to continue to sell off, because the discount rate will continue to rise based on that 10-year. So if you had, for instance, Microsoft and Google and some of these other companies that might even be good companies, but because their prices were so high, your cash flow yields were sometimes less than 5%, you're not going to take the risk of buying those stocks when you can just invest in a government bond for 10 years and get paid 4.5%. Okay, it's just crazy. So the price of the stock, therefore, the market will drop down. They won't be willing to pay as much because the risk-free rate is rising. I'm sure you're following. I hope you are. So here, what would that look like? Again, our target here for the US 10-year was around 3%. I mentioned before, based on looking at Christopher Joy's work. And now I think it may get up to 4.5 to 5%, and then something will break in the overall economy. So this is why cash flow is going to be absolutely key for us. And I'm going to sacrifice my own tax situation, focusing more on dividends, because then at least I'll be able to allocate more into different areas of the fund. Okay, so capital allocation, free cash flow yields of more than 15%. Okay, I'm not swallowing the growth value, the growth narrative. We've been pretty good with free cash flow yields, but it's just going to be absolutely front of mind, and I'm going to ignore what anyone else says about that. More focus on dividends if we can. Obviously, they have to be sustainable. Stocks trading at large discounts to net asset value. Okay, and obviously that's something we've always been doing. So net asset value or total book value. We're looking for either assets or asset producers that have a scarcity of supply, and oil obviously is the bigger, or the energy sector. The whole energy sector is has a real dearth of supply. And at the same time, it has inelastic demand. So it doesn't matter what the economy is doing. You still have to have the lights on. You still have to drive your car. You still have to use, we still have to use energy. Okay. We might not use as much, but the drop in demand is not going to be offset by the supply. The supply dearth is so low, we can drop demand as much as we physically can, and there's still a huge gap to be overrun. And that's going to take years and years to resolve. This trend appears to be getting worse. If you look at what the current administration in the US have done with their canceling more leases for gas and oil, that is not going to bring the prices down. The prices are going to remain higher for longer. And so again, this is where I'm a little bit annoyed. I've seen this coming for a long time. I've invested in my personal portfolio perfectly to take advantage of this, and I simply didn't do as good a job with eToro, but that is about to change. And here I'll be backing my views, even though they are contrarian, and though a lot of people swallow the mainstream narrative. I've tried to remain, I guess, kind of politically correct in a lot of my positions, and that's out the window. I'm sticking with what works. Okay, let's take a look at the types of opportunities and why energy is going to be overweight in the portfolio, even more than it is now. If you look at free cash flow yield, enterprise value to cash flow, so that's taking into account the debt of these companies, using a base factor of $100 WTI for oil in the next year. Here's a chart from Eric Nuttall at 9 Point Partners showing all the major US and Canadian oil and gas producers and what their yields are. So as you can see, the average, if you take the whole sector that he's put here, if you take the average, the free cash flow yield is 30%. In other words, if you put $1 in that business, you will expect to get your money back in slightly over 3 years from the free cash alone. Okay, there just aren't many opportunities out there that are this good. And so it's time for me to stop worrying about diversification, all this sort of stuff, and start to really weight towards the best opportunities. This is also really important because if you think about it, it doesn't matter what the stock market does over the next year, the next year and a half, the next day. It doesn't matter what price people are willing to bid in the auction for these stocks, because you're going to get that free cash flow coming in, year out. Okay. And so I think this is where we really need to focus our attention. Another thing about this is that I invested a little bit into oil and gas futures and exchange traded notes when they went negative in 2022, and I did really well. But unfortunately, the timing was bad for me because I just bought a lot of real estate. I didn't have a lot of free cash to invest. So the cash that I could invest, I did well. But this is another opportunity to invest at essentially at $60 to $70 of oil. Why do I say that? Because the market, the price that the market is assigning these particular companies is discounting $60 to $70 WTI. And oil is already trading at $100. And I think oil is more likely to go up than it is to go down, given the reasons that I've mentioned. So it's almost like I'm getting a somewhat of a second chance to get into the oil trade at a much cheaper multiple. And so we're going to be, or you'll see me scaling into these over the next week in particular. Here's another interesting chart. Using that idea of free cash flow, what is the average buyback period? Okay, so what does that mean? It means out of all the companies, how long, based on the cash that they're earning at current oil prices, how long would it take them using that free cash alone to buy back all their shares? So to buy back all the stock, and the average is 2.9 years based on this chart. 2.9 years, you're getting your entire investment back. And these, in the case of Synovus, not only do you get your entire investment back in roughly, we'll call it 3 years, but they've got more than a decade's worth of well life. So it's not as if they're running out of oil and gas. You're going to get that for free, essentially, if all else remains true and correct. And so that is something that I want to be involved in. So you say, well, what's the likelihood of oil maintaining its current price? Look at this. There is no oil. No one's drilling for oil. We've stuffed this up in the Western world. Okay, we have just absolutely stuffed this up. You and I are going to be using oil for the rest of our lives, as far as I can tell. And the demand for oil is not going down, it's going up. Okay. and the SPR has been released, that needs to be refilled. In short, there's not enough oil. So when there's not enough of something and there's a lot of demand for it, the only relief is the price. Okay. So I'm really confident that oil over the medium term, at least, is staying stable. Yeah, I mean, it'll fluctuate. If we come out and we get a resolution to the war in Ukraine tomorrow, which I hope we do for humanitarian reasons, oil might drop down to think that, the Russians might be able to put their supply back online. But A, it's not going to be enough to make up for the supply dearth. And B, just because the war ends doesn't mean that sanctions will. Iran is still under sanctions since, I believe, 1979. Venezuela is still under sanctions. Someone's got to bring oil onto this market. And everything that we're seeing is the US reducing access to oil, and no one else wants a bar of pumping more from OPEC plus. Okay, so let's look at the ratios. Okay, so let's look at the broad index versus some of these particular sectors. So the commodity index, let's take a look at its all-time highs. This is measuring how expensive commodities are versus the SPX, okay? And so here you'll see we've got a long way to go before we mean revert, okay? If you look at, here we've got the uranium sector represented by the URA, okay? So the Global Uranium ETF. I've done it this way because it's got both the producers and the actual commodity itself. So if we take a look back over the last bull market, if we merely revert to the last bull market, which I believe we were highly likely to do, I mean, we've got more demand for energy than we did 10 years ago, that would expect a five-fold increase in terms of the rise of the price of the money flows. Take a look down here at the bars. The bars represent volume, so in and out. Okay, red, obviously you got more volume going out than you do coming in, so you got higher selling pressure, drops the price down from its previous close, and green is the opposite, of course. What I want you to look at is the size of the bars have been increasing. That means more volume, both in and out. So here, the sector's been asleep since Fukushima. No one wanted a bar of uranium. So look, for years and years and years, the thing has just crawled along. And so we've been eating up all the supply. Now we've got several catalysts for uranium coming onto the market, which you all know about. Sprott Physical Uranium Trust is eating up the supply. And you've also got Japanese restarts coming online. So you're going to have to get uranium to all these reactors. Not only in Japan, but China are building 150 of them. I'll do a separate thesis just on uranium. Another opportunity that we'll be investing in is shipping and transport. So SPX versus the BDI, okay? And you can see where we've been in the past. I believe that there's a big change coming in terms of shipping rates. Okay, I said that I'd be concise. It's about as good as I can do for today. Thank you very much for watching. If you have some funds and you like the way that I am setting up the portfolio, you can copy the portfolio on eToro. If you're just interested in following along, please add me to a watch list and like and subscribe. If you've got a comment or if you've got questions, I would love to hear from you. Get some great comments in the comment section. So please leave them in the comment section. And as always, key notification, I'm not a financial advisor. I'm not your financial advisor. I don't know your circumstance. And so please, everything I say here is my opinion, they're my thoughts, and it's just what I'm doing. It doesn't necessarily mean that it's right or that it's right for you. So you must take responsibility for your own decisions. And having said that, I hope you enjoy the video. And if you have any questions or anything you'd like me to cover, please put them in the comment section, and we'll see how we go throughout the rest of the year and how the portfolio allocation turns out.